After much anticipation, the Fed finally announced a new quantitative easing program that's open-ended and is focused on mortgage-backed securities last week. While the European Central Bank's announcement of outright monetary transaction paved the base for a risk rally, stocks further skyrocketed after the Fed's announcement. The S&P 500 jumped another 1.9% over the week to close at 1,465.77 and is now just less than 7% from its all-time high of 1,576.09 set in 2007. The Dow closed at 13,593.37 and was even closer to the 2007 high of 14,198.1, just 4.3% away. The dollar index lost 1.75% to close at 78.84 and further confirmed the medium-term trend reversal scenario. There are a few important developments to note. Firstly, even though risk markets staged a strong rally, commodity currencies did not show the most gain. Instead, the euro was the strongest currency last week. We've mentioned last week that the euro has shown sign of a broad-based trend reversal, and the impressive strength in the common currency affirmed this view. Secondly, euro Swissy managed to extend the prior week's rise even though the Swiss National Bank maintained the floor at 1.2 rather than raising it to 1.22. Such a development is an important vote of confidence for the euro. Thirdly, US Treasury yield has indeed jumped after the Fed's announcement. That could partly be due to the fact that the Fed's QE3 is focused on mortgage-backed securities rather than a range of bonds. Also, some attributed the surge in yields as a response to the Fed's change in stance towards inflation. The surge in 10-year and 30-year yields has indeed boosted up US dollar, Japanese yen and made yen the weakest currency. So, looking ahead, we'd prefer to long euro, Japanese yen in near term. In particular, if the Bank of Japan follows the ECB and Fed by announcing some additional easing measures this week. To recap, Fed Chairman Ben Bernanke announced a number of policy changes to stimulate the U.S. economy. First, he initiated purchases of agency mortgage-backed securities, starting tomorrow at a total of $23 billion through to the end of the month and then at a rate of $40 billion per month for an open-ended period. Buying would continue until the employment market has shown desirable improvement. This program will be different from the previous one which had defined a fixed period and amount. The Fed maintained the option to alter the size, pace and composition of its asset purchases, as appropriate, suggesting the purchase amounts might be adjusted depending on economic conditions. Meanwhile, Operation Twist will continue through to year-end. The interest rate guidance was adjusted as policymakers decided to keep the Fed funds rate at 0 to 0.25%, at least through mid-2015, from a previous forecast of late 2014. More importantly, the Fed stated that it expects that a highly accommodative stance of monetary policy will remain appropriate for a considerable length of time after the economic recovery strengthens. This is stronger language than previously used and indicates the Fed's commitment to leave interest rates at low levels even if the outlook begins to improve. In the Eurozone, Germany's constitutional court rejected the motion to block the European Stability Mechanism, as widely expected. The news was welcomed by all European officials and Luxembourg Prime Minister Juncker said that he will convene the first board of directors of the ESM meeting on October 8. Nonetheless, the court also requested that Germany's liability through the €500 billion ESM must be capped at an agreed €190 billion. And the Federal Republic of Germany must express that it does not wish to be bound by the ESM treaty in its entirety, if the reservations made by it should prove to be ineffective. Today's ruling was a preliminary one and full review will be considered together with the ECB's planned OMT and will be completed in December. However, markets do not expect the court to make a U-turn. The September Swiss National Bank statement was uninspiring as policymakers decided to leave the 3-month LIBOR target at 0% and the minimum exchange rate unchanged at 1.20 Swiss francs per euro. The central bank continued to pledge that it is committed to buying foreign currency in unlimited quantities, in order to keep the euro, Swissy at this level. Concerning the inflation outlook, the SNB revised lower its growth and inflation forecasts. With inflation in negative territory this year, before recovering to mildly positive territory in 2013, there is virtually no inflationary pressure in the country in the near to medium term. The final Reserve Bank of New Zealand's statement from Governor Alan Bollard was largely unchanged from July's. Yet, after looking into details, this one delivered a more dovish message than the previous one. The central bank left the official cash rate unchanged at 2.5% but pushed backward the timing of the first rate hike to the end of 2013, from mid-2013. Global economic headwinds will eventually affect domestic developments, while monetary easing from other major central banks has sent the New Zealand dollar higher and higher. The market has now priced in a 50% rate cut from the current level next year.